Hey everyone, welcome back to another episode of the 2Ds podcast. So for today, we're going to do a quick and dirty valuation of Shopify share price using a DCF. So just give me a second. I'll share my screen and kick us off. Ruben, can you see my screen?
Yeah, sure. I can see your screen. Yeah.
Okay, cool. So guys, let's look at the variables one by one. So Shopify is, it's a fast growing company and it has years of growth ahead of it. In fact, I can argue that growth is still getting started. We wanted to be slightly optimistic in our numbers. So to begin with, we are assuming that Shopify can grow its free cash flow at a rate of 30% per annum for the next 5 years, as you can see here. So, Ruben was pointing out to me just before the call that Shopify is, it's an internet business, right? And it's you can think of it as a toll gate business. So they enable tools for e-commerce and they just take a commission, right, Ruben? That's the business model.
Yeah.
And as a result, they don't need to make too many capital investments.
Yeah.
So why this is important is because if you look at the formula for free cash flow, it's simple. It is cash flow from operations minus the capital investments required for a business. Since capital investments for a business like Shopify tend to be on the lower side of the averages, we are assuming that they can grow their free cash at a slightly higher pace as we move forward. Ruben, do you agree with that?
Yeah, sure. I mean, these numbers are not for Shopify, so just don't confuse. Yeah. Are these for Shopify? I'm not sure.
Yeah, these are for Shopify.
Okay, these are for Shopify. Then it should be fine. Yeah.
I plugged them in yesterday. Yeah.
Okay.
All right. Yeah. So the growth rate is 30% for the upcoming 5 years. These 5 years.
Following 5 years, 25. Yeah.
Yeah, and then we're for the 5 years beyond that, we are assuming that growth slows down a little bit, decelerates a little bit, but it doesn't drop too much. So Shopify will still continue to grow its free cash by 25%. And the expectation for us from owning the stock is 15%, which is not too high or not too low. Terminal value. Okay, Shopify is a great business. So I think we can give them a higher terminal value. Let's say 25 times free cash. So basically what I'm saying here is at the end of year 10.
No, but one thing about Shopify is this doesn't have a strong moat, actually. So we just don't know how the future of retail is going to be like. So so I'm not sure if anyone want to pay 25 times the free value, free cash flow at the end of 10 years, because we just don't know. Yeah, basically.
Okay, that's an interesting perspective. You are right. No one can predict the future. But I think given that e-commerce sales as a percentage of total retail sales is increasing, I it's just my 2 cents. I feel that Shopify's sales and free cash flow will just keep increasing, but no one can predict the future. So let's wait and see. So Roman, then what do you say, 20 times?
Yeah, we just go for 20 times because we gave 25 for NVIDIA, right? NVIDIA, they have the strong R&D. So they actually build up the expertise over a period of time, which actually acts as a moat. Okay. These guys are just doing coding, then yeah.
Okay, fair enough. So what this means is at the end of 10 years, assume we're just going to sell off Shopify, and we net a price of 20 times the previous year's free cash flow. Okay, so the last recorded free cash flow, we pulled this from Morningstar, was 0.46 billion, and the cash and cash equivalents sitting on the balance sheet as of this moment is 7.5 billion. So let's get to the DCF part. So the first 5 years, we basically we take this number and we grow it by 30% year on year. So this is how you get these numbers. And for the 5 years beyond this, years 6 to 10, we take this number 1.7 billion and grow that by 25% year on year. And like we were explaining, at the end of year 10, you take this 5 billion and you find a buyer for the entire business who is willing to pay 20 times this number. So that's roughly $100 billion. To be specific, it's 104 billion. And as usual, what we did is we took this free cash flow numbers and we discounted them back to today using a 15% expected rate of return. Okay, so at the end of all this, what do we end up with? $35 billion for the present value of cash flows over the next 10 years.
Yeah.
Cash of 7.5 billion, like I explained here. Debt of 1.1 billion. That's not too high. And the equity value for the entire business is 41 billion. How did I get this? I take the present value of future cash flows, add that to the cash on the balance sheet, and subtract the debt, and that's how I end up with 41. Now they have a total of 114 million shares outstanding. So if I divide 41 with this guy, I end up with a per share value of $360. What's the most recent share price? $663 per share. So as you can see, it's 84% overvalued. This is despite, actually, why don't we just show the share price. So this actually took a big beating. If you see that, so
it was close to 1K, and it was maximum was 1.7K, right? 1.8K.
Yes, the 52-week high. Where is that? It was 1.7K, and it started off 2022 at $1,300 a share, and that's been cut in half now. So this is what happens, guys, when you buy overvalued businesses and you pay like any random multiple without looking at the valuations. Okay, so at the end of each DCF, Ruben and I, we do an interesting experiment. We like to see what kind of growth rates is the market baking in at the current share price. So we did the calculations before the call, and you'll see that if you plug in 40% of free cash growth for the next 5 years and 35% free cash flow for the 5 years beyond the next 5 years, you'll end up with roughly $665 per share. That is very close to the current price. Now, granted, that's a very optimistic growth estimate, but I think since Shopify was growing at revenues at more than 50%, right, Ruben? We were looking at it before the call.
Yeah.
So I think the market is just extrapolating that to infinity or something, and people are just willing to pay a very high multiple. Yeah. Okay, so one final thing before we finish. The end of 10 years, we told you that we'll be selling the business for a valuation of.
I think we should go back to 30-25%. Right?
Oh yeah.
So this is for current price.
Yep. Sorry about that. Good catch. 30 and 25. Yes, there we go. Okay. So as we were explaining, at the end of year 10, we'll be able to sell the entire business to a buyer for 20 times the last cash flow. So you get $100 billion. And let's assume there's no dilution. All right. So what is the share price in the future given these conditions? 104 billion divided by 0.11.
1K, right?
So it's about $912 per share.
Yeah. So people who still bought at all-time high, expected to lose half their value.
Yeah, I'll just say a prayer for them tonight before I go to bed.
Yeah.
That they're yeah. I mean, we don't want anyone to lose money, guys. We're not making fun of anyone, but we want people to learn and think through these numbers.
Yeah, and that's why we are actually making these videos.
Yeah.
So our Two Idiots podcast will always be depending on this point. This will be a major topic for our channel. Yeah.
Absolutely, financial education and valuations. Yeah. Well, that's all we have for you today. This is Ravi signing off, and Ruben, my wonderful co-host on the other side. Thank you, guys. I hope you had fun watching us build out this DCF. And as usual, we're going to leave a link in the video description. And invest responsibly. Take care. Have a great weekend. Bye.
Bye.